the central banks are out of the picture at that point. It's a psychological change where people, where the shift suddenly is that money is losing value, get rid of it.
Wednesday, December 16th, 2020, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Rafi Farber from the Endgame Investor. I spoke to him about 3 weeks ago. Prior to that, I had read an interesting article he had written for his blog, and you can find his blog and all the details on Seeking Alpha. I'm going to put a link to that below in the description as well of this interview. And Rafi can also tell us a little bit about his services. Rafi is an Austrian school thinker like I am, and that's why I found his article maybe about 6 weeks ago interesting, and I got in contact with him. And things have gotten really interesting since we last spoke. For example, the dollar index at the time was above 92. Right now we're testing 90. And Rafi's been looking at some of the things that I've been looking, like M1, the deficit, and the dollar. So Rafi, let's start and tell us what you think is the most important thing going on right now in the world of markets and finance and currencies.
I don't know if there's a single one most important thing that's going on. I mean, we have to approach this situation with a fair share of humility, because something like this has never happened before in the monetary world in terms of it being a global event. I mean, there's been hyperinflations, there's been crack-up booms in isolated countries in many different periods of time throughout human history, but I mean, we've never seen it on a global scale, so I don't really know exactly what one thing to focus on is, but I mean, I'm looking at a lot of different things, and I can give you a few examples. One very minor thing is, the dollar index itself. I mean, we spoke last time we spoke about hyperinflations in terms of consumer prices. They usually start in the foreign exchanges. They start overseas with foreign holders of your currency. And it's a pretty logical explanation. When foreigners no longer want your currency, they'll send it back to your country, which on the one hand, decreases demand for that currency. So your imports become more expensive. And also the sheer quantity of the currencies, because they're sending it back to the home country, goes up. So those two things simultaneously, they tend to raise prices for imports, and then consumer prices go way up. So, I mean, I'm looking at the dollar index right now. It looks very, very weak, and there really should be a technical bounce. I mean, I'm not a technical trader beyond the very basics of what technical analysis is, in terms of looking at averages and regression to the mean and that sort of thing. But there have been no bounces since, I think, mid-October, maybe. I haven't looked at the chart recently, but for a few weeks, or maybe 6 weeks or something, there hasn't been any big technical bounces, and there should be some kind of strong bounce in the dollar index, but there hasn't been. So the other thing on the flip side of that, on the mirror, what I'm looking at is the sheer quantity of currency that's being introduced into the banking system. And this, you mentioned M1 and M2, so I wrote about that. These are numbers I've been following for a long time. I've never really focused on M1 versus M2, and M1 is kind of subsumed within M2. M2 is basically, M2 is savings accounts plus checking accounts, and M1 is mostly checking accounts. It includes cash currency, but that doesn't really change much month to month. So it's checking. M1 is checking accounts, and M2 is checking plus savings. So I've been focusing for many years on M2, but I found this I wouldn't say completely by accident, but I looked at the money supply figures 2 weeks ago, and I noticed a big jump in M1, and like something that I've never seen before. And then last week I saw an even bigger jump in M1, but M2 remained pretty much stable. So what that would have to mean is that money was moving from savings to checking. And when when money moves from savings to checking, people, businesses, I don't know exactly who's moving the money. I mean, it could be individuals, it could be companies. It's probably companies because the figures are just so crazy. M1 has increased by $1.33 trillion over the last 2 weeks. I mean, that on a non-seasonally adjusted basis. I don't really pay attention to the seasonally adjusted numbers so much because I don't really know what a seasonally adjusted dollar really is. But for that amount of money to be moved from savings accounts to checking accounts is just unprecedented. I mean, since 1975, I mean, from all the way from when the records begin at the Fed's website, the amount of M1 has increased by, I think, 25% in 2 weeks. I've never seen anything like this before, and the amount of savings has decreased by a little bit less, 1.25 trillion, I think. So I looked in the past. I didn't do like exhaustive research on this, so there's a lot more to do. But I don't know if we have much time to do it. I haven't done this yet, but I looked in the late 70s in terms of the M1 numbers, the checking accounts, and in the 70s, the M1 increase was something like 15% from 1978 to 1980, and M1 was only like 10%. So M1 outstripped M2, and M1 is what you pay bills with. It's what you pay your grocery bills, or businesses pay their business expenses. This is not investing money. Investment money that that's put into money markets and stocks. That's mostly from savings, from non M1 M2. So in the late 70s, M1 outstripped M2, and what you had was rising commodity prices and falling stocks, or stagflation. So then I looked at from 1998 to 2000. I remember I was just in high school. I was a kid, but I remember everyone was crazy about stocks, and money was going into stocks in the dot-com bubble. And there was almost no inflation. Gas prices were very low. It was almost like the Pax Americana. So I looked at that, and in those 2 years, M1 didn't change at all. It was level at about 1.1 trillion or something like that. And non-M1 M2 savings deposits increased, I think, 31%, if I remember correctly. So that means all this money was going into investment, and stocks were going up, and bond prices were going up, and yields were going down. So, I mean, that's what it looks like. It looks like to me that savings account money goes into stocks, and checking account money goes into paying bills. So if M1 is rising so fast and M2 is falling so quickly, then that probably signals that consumer prices are about to go up because people are about to start circulating that M1 cash a lot faster. And you can ask the question, why is this happening specifically now? My answer is, honestly, I don't really know exactly. I have an idea maybe why, but even if I'm wrong about why, I mean, it's happening. That much I know. I think it might have to do with these mortgage moratoriums and all the payment suspensions that were instituted after the initial bailout, the CARES Act. Once now those are about to expire, so I think companies are taking money out of their savings account, or people are taking money, or mortgage owners, big institutional mortgage owners that have to start paying their commercial mortgages again. They're transferring money out, and they're about to pay it. So that means this money is about to start circulating in checking accounts, and then people are going to try to get rid of it to spend on goods. So if I'm right, then we might be weeks or maybe a few short months away from some serious rise in consumer prices.
Yeah, and then people will finally wake up to the fact that there is inflation in the classical sense, but that it was earlier, as you said, it was just staying in the M2 where people were putting in investments, but now it's going into M1 and more real consumer goods. Can you also touch upon, because you cover that a lot, how Uncle Sam, or the U.S. Treasury, has a lot of debt to roll over? I saw recently someone put up a chart that in the last 2 weeks of this year, the Treasury's got $1 trillion worth of treasuries that are coming due that they're going to have to roll over.
It's more than $1 trillion. So I think I looked at this like 2 weeks ago. I look at it every month. Every month the Treasury releases a file called the Monthly Statement of Public Debt, the MSPD. and it lists there all the bills and all the treasury bills and the notes and the bonds that are coming due at what time. So there's three kinds of treasuries. There's bills, which is from 4 weeks to 1 year maturities, and then there's notes, which is 2 years to 10 years. Those are the most. Those are the ones that the Fed usually buys. And then there's the bonds, which is a 20-year and 30-year, and that's it. So in Treasury bills, which were used to fund the last bailout mostly, I think it's coming due now is something like 1.5 trillion, 1.527. I don't know exactly. I think that's the number, 1.527, coming due at the end of before the end of the month. So that means they have to raise that much in order just to break even on bills, and they can do it. It's possible, but in order to do that, they have to raise emergency funds through something called a cash management bill, which typically is only used in emergencies. But now it's issued regularly 4 times a week, twice on Tuesdays, twice on Thursdays, and about $500 billion is raised with this stuff every month, and then they have to raise the rest through classical bills. But that means that this cycle is going to keep repeating. This can keep growing because it's not like they're balancing the budget; they're spending more and more. So it trends higher and higher, and in order to pay this back, they have to raise that much. So where are they getting new money from? They would have to get it from notes and bonds. That means from the calculations I did, it's something like they have to between triple and sextuple the rate of issuance of notes in the middle of the curve from 2 years to 10 years in order to raise the amount of money they say they want to spend for the next bailout. So again, I don't really know how this math is even going to work out in a basic sense, and because all the financial media focuses on all these vacuous, dumb questions they just keep repeating it. Nobody's focusing on any of this stuff. It's just not there. I mean, you talk about M1, M2, they would have no idea what you're even saying. But I mean, it's out there. I mean, thank God for this is how people make money in the market, when nobody's paying attention to something and it's right there in front of your face. And if you just follow reality to its logical conclusion, it seems pretty obvious this is going to happen. Exactly when, I don't know, but you have to, if you want to play this, you have to have the staying power. If it takes a month, if it takes 2, if it takes 6, it's going to be soon. But that's all I can say.
Yeah, and you give your readers and subscribers a really good service. You talk about, where you're going to go in, where you're going to get out, how much cash to hold. But can you also tell those people who are not traders, who are more in for the long haul, what you think the fundamentals are for like precious metals, commodities, in view of the fact that Uncle Sam is just out of control? I saw that recently they published some data that China is decreasing more and more the amount of treasuries it holds. Right now, it's still a controlled decrease, but if what you're talking about, all this tripling or sextupling the amount they're borrowing is coming online, it makes you wonder, how much longer foreigners are gonna take these notes and bonds and bills at such low rates, which could mean higher. The only way that Uncle Sam might be able to finance this is through higher rates, which means lower bond prices. But then at the same time, the Fed doesn't want to see rates go too far, because you could bring down the whole house of cards.
Well, the house of cards is coming down any way you slice it. It can't stand up. So I mean, about gold and commodities. I mean, I call myself the end game investor, as if I'm investing in a catastrophe. But really, this isn't really investing in the classical sense. Buying precious metals, it's not investing really. It's hoarding money, because we see that the monetary medium that people are using is being poisoned, And when the monetary medium breaks down, you have a total misallocation of capital, even on the retail level. And a misallocation of capital on the retail level means that some people can't get food. Some people can't get what they need. And then you have like close to a societal breakdown. I mean, I'm not trying to freak anybody out here. I don't think, I mean, at least I hope division of labor is not going to break down, because there is still real money out there. It exists. It's called gold and silver. It's there. You can use it. You can get it. So when we're talking about buying precious metals, it's not really talking about investing so much as preparing for some kind of massive shift in the way humans divide goods and services. I mean, so when I buy precious metals, I realize that I'm a trader and my subscribers want to trade, and I do too, because that makes me feel, smart, and if I do it correctly. But I only trade with a certain amount of play money. I have a core position that I do not sell because I know this is coming. But I buy and sell the tradable positions in and out, depending on technicals and maybe some events that might have. Like, for example, if there's a no-deal Brexit and the European Union falls apart, and I don't know how people are going to react to the euro, if it's going to go up, if it's going to, I don't know. So I want to hold cash, and if I lose money because gold skyrockets and I wasn't fully invested, okay, I can live with that. But if we have like a sudden sell-off in precious metals for a week or two because everyone's panicking and banks need dollars, which is possible, then if you're too fully invested and you need cash, then you can get knocked out, and that's dangerous. So yes, in the long term, I'd say I don't really see this lasting more than a year or two. It could, but I can't see it. So in the meantime, you have to hold that core, and because the end game is coming, which means that all the purchasing power that is now in the market cap of dollars, whatever the market cap of dollars are, or the market cap of all fiat currency, you could even say, is going to transfer itself to gold and silver and copper and commodities, mostly in the monetary media, because that's how people transact. But yeah, tangible commodities that people use are also going to go up in value, and that would be more investing. But because I don't know exactly what's going to happen to these commodities, I mean, if the division of labor really gets hit, then I don't know how much a barrel of oil is really going to be worth, because what are people going to use it for when everything is in chaos? So yeah, you can invest in commodities. You're not going to lose out in the long run on that. But for the immediate end game that's looks like it's about to hit, you'll need real money. You'll need gold and silver to figure out what to do, and then when things calm down, then you can start investing again.
Yeah, and like you said in the beginning of this interview, we've never been through a situation like this when the major countries of the world, the major reserve currency, are going down the path of like the crack-up boom or hyperinflation. It is scary. I mean, I lived through that kind of scenario in Brazil, growing up in Brazil, but there was an alternative at the time. It was the dollar, and I remember, when there was a collapse of the currency, it took a few months for things to stabilize, but it picked up again. But with the whole world falling into this kind of scenario, it is, like you said, very difficult to know. And even if we don't, even if they can keep this thing going for another 5-10 years, which I doubt it, I'm more in the camp that you are, maybe another year. Even if they're able to keep it going, it doesn't hurt to have physical gold and silver and be outside the system, like you said, and have some, of course, if you're a trader, have a little bit of, playing money on the side, money that you're not like, worried at night, that doesn't worried at night about losing it all. And that's the way I play it too. With that, I wanted to ask you, because you spoke a few weeks ago about, and this I think happened in September, but I haven't seen it talked much about in the even in the alternative media, it's about the gold ETF from the Perth Mint. Can you tell the viewers what happened there and how it shows the pitfalls maybe of trusting ETFs?
Right. So this is very interesting. This is actually something that I didn't notice this myself. I had a new subscriber came aboard to the Endgame Investor, and he our main gold position, gold ETF position actually, it still is, and I'm about to get rid of it in a few shortly. But it was the symbol is AAAU, triple AU, and it was the Perth Mint ETF. So I chose that ETF over any other gold ETF because they had a policy, they still have this policy technically, that any owner of this ETF can transfer the shares to the Perth Mint through the brokerage and then redeem it for physical gold. So this and the expenses on the ETF, all ETFs have a decay rate that they use to pay the custodians and whoever's guarding the gold. So there's a decay rate on all these ETFs, and AAAU had a very low, I think the lowest decay rate and the best redemption policy. And then I think 2 weeks ago, a new subscriber came aboard, and he noticed that the Perth Mint was selling the entire ETF to Goldman Sachs. And then once the transaction hasn't completed yet, so I haven't sold it. But the whole ETF is going to Goldman Sachs. And it explicitly said once this deal closes, it is anticipated that owners of this ETF will no longer be able to redeem their shares for physical gold anymore. So yeah, it's like it's been assimilated by the Borg, and it's one more ETF that's become irredeemable. And the question is, why would Goldman Sachs do this now? I mean, they're one of the main bullion banks that has a humongous short position in London on London bullion. And I think the total short position of all bullion banks, which Goldman Sachs is a part of, is like something like $37 billion of bullion, or 36 billion, or some kind of record number. All-time record keeps going higher. So why would they take an entire ETF? Because they need access to physical gold, and so they don't get squeezed if something happens, and then they can just take it and cut everyone off. I mean, that's what I think. But there are other ETFs that still do redeem, that are like independent, run by smaller parties. They're a little bit more expensive, but really, if you want physical gold, I mean, I would suggest opening up a service account at a storage service. I wouldn't store physical gold at home; it's too dangerous. It's too valuable. Physical silver, yeah, you could, a little bit. Just for retail purchases, but physical gold, you'd want a service that's outside the banking system. I use goldmoney.com. You can use whatever service you trust, or I think you can also still store your gold at the Perth Mint physically, not through the ETF. So maybe you could do that. It just takes time with these KYC laws to open these accounts. So if you haven't done it, do it now. It takes like a month or two. You got lawyer stamps and certified documents and all this. So in the meantime, an ETF would do for now if you're scared of missing the boat.
Yeah, the other service that I have a referral code for is called Glint. And Glint is based in London, and they store your gold in Switzerland, and it's allocated in your name. And they also give you, they have an app, the Glint app, and they give you the possibility of also spending that gold through a MasterCard. So that's another option to Gold Money, I would say. My referral code, by the way, is Mario Glint 79. Just put that out there. Yeah, and GLD as well, because these bullion banks, I don't really trust the bullion banks, because they work really for the central banks. And if you look at GLD, the custodian or the people who run it are like people like State Street and HSBC, big bullion bank as well. And now you're going to have Goldman Sachs running the AAAU. So yeah, I would stay away from those. I think Sprott Asset Management, I don't know if they do Sprott Gold, but they definitely do Sprott Silver. I would trust them too. So
yeah, I think Sprott has like a mixed gold and silver ETF, but yeah, I would trust Sprott because he's one guy and he has his own. Yeah. And he's in charge of his people. I'm sure there's a board, and he's not, he's not a dictator, but I would definitely trust my gold in the hands of Eric Sprott more than I would in the hands of Goldman Sachs, for example.
That's right. Yeah, yeah. So I saw the other day that because the first time I read your work was you were talking about how some gold mining companies are starting to pay dividends. But recently I saw that one of the shares that I have, one of the silver miners I have, First Majestic Silver, announced that they're going to start paying dividends next year. So I thought that was quite interesting as well. Did you see that?
Yes,
The news
yeah.
on that?
I did actually. This was another point where a subscriber notified me because they find things quicker than I do. I'm more focused on the monetary side of things. So like I know I look at the banking system, I look at the treasuries, but yeah, so we have a good community and people share information. It's helpful. People have expertise where I don't. And they find these things, but yeah. So First Majestic is one of the stocks we own in the portfolio, and I've always liked. They've always been pretty conservative with their finances, and it's a good company. And I even bought. I actually, this is a cute story. So my kids, I try to educate them in what money really is. I mean, I'm a religious Jew, so in Orthodox Judaism, kesef in Hebrew for money means silver. Kesef is the word for silver. It's also the word for money. And and Abraham bought the cave of doubles in Hebron to bury Sarah, with 400 shekels of silver. It says over la socher, meaning a negotiable currency or good currency. So silver is money in Jewish law, whereas paper money is a little bit less of a status. So I have them do chores, and I pay them a few shekels here and there for sweeping the floor or mopping or setting a table, whatever. And they accumulated a few hundred shekels, and then they wanted to buy some silver because I talked about money all the time, and they're like, I don't want to lose my money, so can we get some silver? So yeah, I went to First Majestic. They have an online store, and we bought $300 of silver for them, and it's still in the U.S. I'm trying to get to the airport over here, but I don't want to pay taxes on it.
Yeah, well, that's good though. That's good. My daughter, she's older. She's in her 20s. She knows. I've told her about gold and silver, and even though she doesn't talk much about it, I know she knows. She even had a little Saturday job once with the coin dealer. I think she was about 14 or 15. So she knows a little bit about the coins as well. The other thing I wanted to talk about that you've been covering a lot is how commodities are going into backwardation and what that could mean. And maybe you could explain to viewers what that means.
So this is a bit of an esoteric point, but it takes a few minutes for your brain to try to wrap around it. And even I get confused when I think about it. But I think I got it down. But so backwardation is the condition where a commodity is more expensive for immediate delivery than it is for future delivery. So you would expect that a commodity would be more expensive for future delivery because the one who's storing it, right? If you're storing a whole bunch of barrels of oil or sheaves of or wheat or oats or whatever it is, so it costs money for the storer to store it, and insurance and whatever else it costs. So he's going to charge a premium on the future delivery, and you're locking in a price. Right, so you're locking in a price on, let's say, wheat in 2023 or whatever that you want because you have a Cisco Foods and you need a supply of wheat to make your bread or whatever it is. So you're going to pay a premium to lock in the price for the future. So that makes sense. That means the future price is higher than the immediate delivery price. That's called contango. So backwardation is when it typically happens when there's a shortage of a good. If there's not enough of something, then the price for immediate delivery of it will be higher than the price for future delivery of it because people need it now and there's not going to be in the future. So they bid up the price for the immediate delivery. So you typically see backwardation in wheat, right before the wheat harvest when there isn't a lot of wheat. And then once the wheat harvest comes in, there's no longer backwardation. And then future prices go up and the spot prices go, the spot meaning immediate delivery prices go down. But the thing is that there's always two sides to any commodity exchange. There's the commodity and there's the dollar. And since the dollar is the reserve currency, all commodities are priced in dollars. So if you kind of like take this and flip it on its head, then when a commodity is in contango, meaning its spot price is cheaper than the future price, which is more expensive, then it's the opposite for the dollar itself. The dollar becomes cheaper in the future and more expensive in the present, because if you're spending more dollars in the future, the dollar itself is becoming cheaper into the future, which is what's supposed to happen. But if people are worried about the value of the dollar itself into the future and they want to get rid of dollars, they don't care about the commodity, they just want to get rid of dollars, then commodities can all go into backwardation at the same time because the dollar is because the dollar is flipping. They want to get rid of the dollars, and they're using the commodity contract to get rid of them. So that seems to be starting to happen now. Because, for example, you have what I noted in my last weekend report, I think, was sugar. The sugar harvest just finished, which means the supply of sugar in the world, wherever it's harvested, is now at a peak, and that is pushing sugar prices a little bit down. But you'll see if you look at the futures tables that the price of sugar for immediate delivery is still higher than the price of sugar for delivery out in 2 or 3 years. And that doesn't make any sense. What is probably happening is that sugar traders, or whoever is buying the sugar, is trying to get rid of their dollars and just getting rid of them by buying contracts so they can have sugar and make whatever they need to make for their business sooner rather than later and stockpile. So I think we're seeing it in lumber and sugar and oats, and soybeans are dipping in and out of backwardation. So it's in several commodities. It's not in all of them, but it's in several of them, and it's not a normal thing.
Yeah, I remember reading. He's also an Austrian school proponent. He's even there's supposed to be a faction away from the Mises Institute. His name is Antal Fekete. I think,
right.
yeah, he's spoken about how when gold and silver go into backwardation for a considerable time, it means that there's something wrong with the monetary system. But I think he should also include other commodities in that, because what you said there about the flip side of the backwardation is that people want to get rid of dollars, and this could be something more to do with the dollar than the underlying commodities, right?
Yeah, it could be, but since none of us have ever seen any of this before, it's not like we can speak from experience where the last time this happened. But I don't know. This is just a logical progression, and hopefully we're not missing a step in the logic, and we've got this thought through. I think we have. I don't see any other way to look at it.
Yeah. So just before we wrap up, could you tell the viewers where they can find your information, what you provide in terms of service, and who do you think really? I actually think anyone who's interested in what's going on in the world of currencies, the dollar, precious metals, economics, would do well to have access to your service or pay for your service, even if you're not a trader. So maybe you could tell the viewers about your service and how much you charge and so on.
Yeah. So you can just Google the End Game Investor, investing in the end game, and you'll find it first link. You can also find it on Seeking Alpha. I do it. My service is through Seeking Alpha, so they handle all the back end stuff, and I can just write. Because I'm a thinker, that's what I do. I think about this stuff every day, so I may as well write it down for other people to share it and to help. So you can you can also find me on Seeking Alpha. I write articles for the free side of the site where you don't have to pay for it, under the pen name Austrolib, as an Austro-libertarian, Austrian school libertarian, Austrolib. You can find my articles there, and they'll have links if you want to subscribe to the premium service. I think it's like $230 or $280 in a discount or something. I don't remember exactly what the price is, but it's not much. I think it's like $25 a month on a monthly. I'm not really charging that much for it. I just want to help people, save themselves from a catastrophe and make a little bit of a living. I'm a good enough trader. I can handle it, and you can also find my articles on the gaming industry. Also, I write for CalvinAir.com. I have a weekly column there, where also from an Austrian perspective, I comment on the gaming industry, and that's been very interesting because casinos have been shut down, and what they've been doing and trying to survive. And also a lot of the gaming industry is in the United Kingdom, which is about to, I don't know, maybe exit the EU without a deal, maybe with a deal. It's been a very very wild industry in the last few months. What I focus on in the endgame investor is monetary analysis, but the main point I try to focus on for traders is that trading, it's not really about making the perfect call every time, though that certainly helps make money. Nobody can do that. That is impossible. You can use clues and technical analysis to try to make your calls a little bit more triangulated and better over time. With experience, you see how things kind of work. But really, it's about emotional management. And traders are mostly their own worst enemies because they're always second, third, fourth guessing themselves. And what you want to do is be in the emotional golden mean, like not too ecstatic about something and not too devastated. So you want a cash position, and to be able to buy the dips and sell the rallies. Buying dips it's hard because when stock is going down, you're like, well, why would I buy? What if it goes down more and I lose? And selling when stocks go up or gold goes up, it's also very hard because, it's going up. What if I sell it and it's not the top and I lose that? But if you're uncomfortable with a trade, you're probably doing the right thing. And if you're chasing and being greedy, you're probably doing the wrong thing. Not every time, but generally speaking, that's how it works. So I try to teach emotional management and just stay calm.
Yeah, and I would also say that if you are going to trade, you should try to make it a full-time business because you need to keep an eye on the markets. I mean, especially if you do more short-term trading.
I don't do day trading. I don't like buy something at market open and sell it at the. I don't do that. By short-term, I mean like when I start to see that during this recent correction from August to September, we had. On very heavy down days when people were panicking, we decreased our cash positions and bought more of the stocks that were going down harder. And then when they started going back up, we started selling more of them with that little money, with that little percentage of money that we trade with. Otherwise, we don't touch the rest.
Yeah, I agree with you. I did a bit of trading earlier this year with options when there's a lot of volatility, but I have a core. I think it's important having a core position. And what does that mean? Well, for those people who don't know, it's having like a position that you're investing for the long term and then trading around that position as well. And like Rafi said, having some cash makes you feel a bit more comfortable if things are not going away. So any last words, Rafi, about what's going on right now and what people should look for?
Look for increases in food prices. I would say increases in food prices. I just heard that there's this shipping container problem from these lockdowns, that shipping containers for international trade aren't aren't in the right places. So like these cargo shipments can't happen. Look for constriction in supply of food or shortages, or there might be price controls, especially after this next bailout is passed, however much it's going to be. If the Treasury auctions can even raise the amount of money that's needed, that's another thing to look at. And track M1 and M2 if you're into monetary economics. If you're not, subscribe to me. I'll keep you updated with the numbers. Watch out for food prices, and make sure you have a reserve of gold and silver in case there is hyperinflation. And when it happens, it's going to be fast. It could be even faster than 1923 because we have these social media. And what last thing to keep in mind is that the hyperinflation phase, when consumer prices really start to go out of control, has nothing to do with central banks anymore. The central banks are out of the picture at that point. It's a psychological change where the shift suddenly is that money is losing value, get rid of it. And if you think that can't happen, I mean, look at what humanity was last year at this time. Everything was normal. People were going out of their houses and living normal lives. And all of a sudden, everyone's under house arrest. And the majority of people seem to be, if not okay with it, then able to tolerate or suffer it without, revolting. So the changes in human psychology, especially in the social media age, can happen very quickly. So this can happen. This hyperinflation can happen very fast. Just be careful.
Yeah, that's what I've told people as well. Once it starts, it's too late to try to get prepared. So you need to get prepared before it starts. Thank you very much, Rafi, for your time. I really enjoyed speaking with you. Maybe we can do it another time, maybe early next year. And I wish you all the best, and take care.
Happy holidays.
Thank you. Happy holidays for you as well.
Thank you.